All right. I think we are live. Maybe. It's a solid maybe. All right.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
Right off the bat.
Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone.
Like this.
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Maybe.
Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace.
Clean that up.
We've covered a lot of ground, and the full effects of our tightening have yet to be felt.
Because, you know, fall off a cliff.
In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
Dude?
And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year.
If you did just make like decent profits,
the jobs to workers gap has declined,
if you're just a day trader scalper,
demand still substantially
there's no shame in not
the supply
losing
of
those profits.
workers.
I'm just letting you know. Right? It's going to
FOMC
be tough to
participants
trade.
expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we've raised our policy rate by 5 percentage points.
Hey, I feel you, dude.
We have been seeing the effects of our policy tightening on demand
there's
in the
no
most
denying
interest rate
we're
sensitive
both going against the
sectors
trend
of the
if
economy,
wrong, but
especially
that's just
housing
how
and
it be.
investment. It will take
And,
time, however,
we haven't
for
seen
the full
signs of a
effects
turn yet.
monetary restraint to be realized, especially
Exhaustion,
on inflation.
yes. Turn, no.
The economy is facing headwinds from tighter credit conditions for
Holy
households
Jesus,
and
look at
businesses,
that
which
thing.
are likely to weigh on economic activity, hiring, and inflation. The extent of these
Sexy.
effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all
I
committee
feel like
participants
so they haven't
expect
used
that it will be
securities
appropriate
holdings,
to raise
which I
interest
feel like
rates
that's like
somewhat further
maybe they're
by the
trying
end
to
of
shock
the
the
year.
market by saying that, because
But
in
at
the
this meeting,
past they've said
considering how far and how
significantly
fast we've
reducing
moved,
their
we
balance sheet.
judged it prudent to hold the target
And maybe
range
people
steady
didn't connect those
to
dots,
allow
but
the committee to assess additional information and its implications for monetary policy.
no, I don't think the Fed holds
In
like
determining the
individual
extent of
stocks
additional
or
policy firming that
SPY.
may be appropriate to
know,
return
SPX
inflation to 2%
and
over
DQ. I
time,
don't think those are the
the
securities.
committee will take into account the
Those are just
cumulative tightening of
treasuries.
monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy
over that.
evolves as projected, the median participant
wanted to
projects
say?
that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that
That's
these
really the only
projections are
change.
not
So
a
yeah, they
committee
did the
decision or
pause.
plan. If the economy does not
there's
evolve
that.
as projected, path
So
for
I
policy
think
will
that's the
adjust
reason
as
you
appropriate
didn't
to foster
skyrocket
our
off of that.
maximum
I think
employment and
that's
price
literally the only
stability
thing.
goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks.
Getting up
We
there,
remain
gotta
committed
watch
to
up here.
bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored.
Got some
Reducing inflation is likely to require a period
366
of lower
lottos there at
trend
the
growth
bottom.
and some
That-
softening
that,
of labor market
That works.
conditions.
Just in case.
Restoring price stability is
you
essential
know,
to
short
set the
squeeze.
stage for achieving maximum employment and stable prices over the longer
But
run.
also, like, hey guys, I'm serious. If you made like a
conclude,
decent amount, there's
we
really no
understand
reason
that
to
our
start.
actions affect communities,
money
families,
back,
and
so-
businesses across the country.
Hey, there's that.
Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they've felt the drag
Maybe.
of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And
The power
that of the
pump,
speed of
let's do
tightening,
it.
the level to which rates would need to go, and then the period of
All
time
right,
over
it
which
works.
we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly. by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation
So
to
that's the
2%
reason
over
I think
time.
you didn't skyrocket.
So the pace of the
in there.
increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and
That's
that
not so
is
bad.
that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach.
All right, so
or-
right here
or
is
really
gonna be
any other
important.
approach. We really were focused on
Break it.
what to do at this meeting.
So there was no kind of initial
for a 5-minute
debate
close
about
over
the
it.
possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision
Really,
about
any
July. I mean, of
close over it.
course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, 2 things. One, decision hasn't been made. 2, I do expect that it will be a live meeting.
All right, so that's where resistance coming from right here.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots. Stronger GDP, less of a hit to unemployment, slower progress on
GDP, you
inflation.
just
And I'm
said,
wondering, in
Was
this,
it like,
where's
were they
the
expecting
disinflation
negative
coming
GDP
from?
last time?
The labor market's
I
going
don't
to be
even remember.
stronger, it looks like. It's not coming from there. Demand is not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It
Wait,
seems
hang
like it's
on.
getting
He
more
said
immaculate rather than a little
0.1%.
messy.
I'm pretty sure,
So
right?
you're-
Is that
you're
not
right
what he
that
just
The
said?
data came
Which
in,
is
I would
well
say,
under the thing. So if he
consistent with, but
doubled
on
it,
the
it was
high side of
0.05%.
expectations. So, and if you go back to the former SEP, the last SEP
know, I could just
in
be
March,
dumb.
you will see that growth moved up. These are not huge moves, but
That's
growth,
something. That's what
estimates
you want to
moved
say.
up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit.
Like also,
And,
this tricky,
all
guys.
3 of
Like
those
you
kind
can
of
say
point in the
something.
same
This thing could
direction,
tank
which
at any
is,
time. This thing
you
could
know,
rocket at any time.
that perhaps
Like, if
more
you made money
restraint will be
earlier,
necessary
it's
than
really,
we had thought at the last
you know,
meeting. So,
quite
although
volatile here.
the level, frankly, is pretty. The level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said,
So that's
and
good.
believed
Hey, if nothing
that
changed,
the process of getting
Pretty sure
inflation
the
down
market
is going
loved
to
it
be
last
a
time,
gradual
so.
one. It's going to take some time. And I think you go back to the 3-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions.
There we
They've definitely
go.
improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation
Whoa,
to continue
you see
to
that
come down
thunder?
over time.
Right.
In terms of housing services inflation,
Crazy.
that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any
with
forecast
the
that people are
lightning
making
bolt.
right
There
now
we go.
about inflation coming down this year will contain
Oh,
a big dose.
it's a bigger
of,
one.
This
Crap,
year and
man,
next year
I'm
will contain
driving that
a
tonight.
good
That
amount
sucks.
of
Oh, well.
disinflation from that source, and that's again probably going to come slower than we would expect. That leaves the big sector, which is a little more than half, of the of core PCE inflation. That's non-housing services. And
You got the 5-minute
we
close,
see
guys. I
only
mean,
the
I'm just
earliest
saying, that's
signs
the trend line of the
disinflation
day.
there. It's a sector. It's a
Wanna be
very
watching.
broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive. And I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Honestly, guys, it doesn't sound too bad to me. We all clearly see. I'm going to talk about this in the video right after this live stream. I just want to wait until I heard what that guy said.
What's the value in pausing
we all
and
clearly could see
signaling
this.
future hikes versus
But hey,
just hiking
I'm gonna
now?
go
I mean,
over
not to
some
be
things
flippant,
in my
but I
video
don't lose
today.
weight just by buying a gym
All right,
membership.
covering
I have
upside
to
and
actually go to the
downside.
gym. 16 of your colleagues put down a higher year-end
Did
23
come down and
rate
fill that
today.
gap,
The
so did we
majority of
bounce
you
off
think
and
you're going to have to
didn't
go up
realize?
by 50 basis points this year.
that
So
off
why
right
not
now.
just rip off the Band-Aid and raise rates today?
So first I would say that
'Cause he
the-
doesn't
the
wanna go
question
too
of
far, dude.
speed is a separate question from the question from the
Once you go too far,
from
you're
that
just
level.
screwed.
Okay,
You
so
just, hey,
and I think if
bring
you look at the
economy
S&P,
into a
that is
depression.
our estimate, our
Do
individual,
it.
it's really accumulation of our individual estimates of how far to go. I
And all the
mentioned
effects
how
from
we got
like
to
a
those
month
numbers.
ago. We're
In terms of speed,
we're seeing
it's
that now,
what I
guys.
said at the beginning, which is speed was very important
Hey,
last year.
that's the
As we
move.
get
There we
closer and
go.
closer to the destination,
Boom.
and according to the SEP, we're not so far
Yeah, I
away
don't
from the
know. I'm just
destination
sitting in these
most
two
people's
lottos, and
accounting.
like now they're up 34%.
It's
but they
reasonable.
were
It's
up,
common
like,
sense to go a
I
little
think I saw
slower, just as
70%.
it was reasonable to go
I
from
don't know. I mean,
75 basis points
they
to
were
50
100% just
to
lottos.
25 at every meeting.
Like also, I'm
And
serious,
so,
guys. You were up earlier. This
the
is really.
committee thought
You got no
overall
reason to
that
even do this. You
it was
guys can literally,
appropriate to
like over in the
moderate the
Discord, I'm
pace,
just literally
if only
scalping each
slightly.
morning.
And there are benefits to that. So that
Until
gives
11
us
a.m.
more
unless I
information to
just
make
see
decisions.
price
We
getting
make-
away like
try to make
yesterday,
better decisions.
and I'll set an
I think
alert.
it allows
But
the economy a little more time to
you know,
adapt as we make our decisions going forward, and we'll get to see. You know, we don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the
Didn't
extent
get
is.
to
We'll have
take
some
the
more
full
time to see that
position,
unfold. I
but-
mean, it's just the idea that we're trying to get this right, and
it's okay.
this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month.
Is this one
What
bouncing
incremental
off the trend line
information
right now?
will the
See,
committee
that's
be using
exactly what he wants
to
to see,
inform their
guys.
judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Yeesh, yo, you guys hear that? I'm just going absolutely berserker out there. Look at this, guys.
Thanks for taking our questions, Gina Smilek, New York Times.
IWM.
You obviously
this is what
in
we
your
called out in
forecast
yesterday's
marked
video,
up
I'm pretty sure.
the sort of path for growth,
Or
marked
not.
down the
Maybe
path
it
for
was in-
unemployment, marked
over
up
there
the
2 days ago.
path for
Using this
inflation
zone as
pretty
your risk
notably.
level.
I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel
Guys, if you
confident
do see
this
the
is
close
as
over
high
here
as
on
you're going to have
IWM,
to
you see the
revise the
close
federal
above the
funds
zone,
rate, or
I
do you
mean,
think it's possible we
got a
could
straight
have
shot
even
up here to
a higher than
190,
5.6% terminal
Something
by
to
the end
keep in
of
mind there.
this cycle?
I mean, on the first part,
higher
I just
rates
think we're
equals,
following the
this is
data,
gonna be the
and
worst on
also the outlook.
IWM.
The economy is the labor market. I
but
think
hey,
has surprised
Pause.
many, if not
Temporarily
all,
could be good
analysts
for
over the
IWM.
last
I
couple
don't
of
know.
years with its
I'm just waiting.
extraordinary resilience, really.
Waiting to see if I get
and
the entry that I want.
It's
Oh,
just
yeah.
remarkable, and that's really,
Oh,
if you
yeah.
think about it, that's what's
Always
driving
hold
it's
the
it's
bottom.
job creation, it's wages
Facto.
moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of we always write down at these meetings what we think the
All right.
appropriate terminal rate would be at the end of this year.
94%. It's like so
That's
little.
how we
I
do it.
was using it as a lotto in case
It's
this guy
based
really
on,
made it squeeze
our,
up
our
here.
own
But
individual
I don't
assessments of
know.
what the most
I'm
likely
like, I don't want to get
path
the
of the economy is.
Take it. I don't care.
It can actually in reality wind up being lower or higher. And there's really no way to know. But
I'm gonna
it
be
is-
so fucking
it's what
salty
people
if this
think
thing
as of
skyrockets,
today,
but like at the
and
same time,
as the
I
data
guess,
come in, it
it
can
is what
move
it
around
is.
during the intermeeting period. It could wind up back in the same place, but it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance.
Slap, Mr.
Is that
Vic,
still
slap
the
him.
case, or has your
Oh,
mind changed about the
Jesus, look at
balance
that.
of risks out there? And also, could you give us an idea of what would be a sufficiently restrictive funds rate? Obviously the current rate, according to the committee, is not sufficiently
You're gonna regret
restrictive.
that?
Is it
Probably.
5.6? Is it 6 weeks or sufficiently restrictive? Thank you.
Okay.
I would say again that I think that over time, the balance of risks as we've moved from from interest rates.
This is why I just want to let this thing get what I got to do in the morning
with,
done, and then
with
hey,
an SEP calling
rest
for
of the day, did you
additional
set
hikes.
your
I think
alerts and just like,
we've
hey,
moved
wait
much
for things
closer
to happen,
to
go about
our
your day?
destination, which is that sufficiently
At
restrictive
least what I'm
rate.
working
And
towards.
I think that means, almost by definition, that the risks of sort of overdoing it and underdoing it are
guys head and
getting
shoulders?
closer to being in balance.
Big
I still
head,
think,
right
and
shoulder
my
here?
colleagues agree
I don't know.
that the risks
see.
to inflation are to the upside still. So we don't
Risk
we don't
to
think we're there
inflation is to
with
the all right.
inflation
So
yet,
that was the
because
first
we're just
not
looking
so
at the
good
data.
thing
If
that
you
he
look
just
at
said, and
the,
I think the market
at
is
the full
immediately
range
realizing that.
of
But then
inflation
again,
data,
guys, short
particularly the core
squeeze.
data, you
We're gonna have to
aren't
see
seeing
about
a lot
this.
of progress over the last year. Headline, of course, inflation has come down materially.
So far,
but
we're
as
not
you know, we
regretting
look at
selling
core
right
as a
there.
better
Tell
indicator
you that
of where
much. But like at
inflation
the end of the
overall is
day,
going.
this thing I'm serious. This guy very
So I
easily
think,
could just make this thing
what
squeeze.
we'd like to see is
It hasn't been so
credible
bad.
evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year, and I think it's reasonable to think that some of that may come into effect. So we're, I think stretching out into a more moderate pace is appropriate to allow you to make that judgment of sufficiency, more with more data over time.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. I wanted to ask further on the lag effects. When you're considering when you would hike again throughout the course of the year, are there things that you would expect to kick in as those lag effects come into effect that would inform your decisions? Have you learned things over the past year that give you some sense of timeline for when to expect those lags to come into effect?
Yeah,
Lottos for 80-something%. I
it's
guess
a
that's
challenging
fine.
thing in
Like
economics.
honestly, guys, in
It's
this
sort of
market, the
standard
only thing
thinking.
I've been really
Monetary
enjoying is
policy
scalping
affects
each day.
economic
I'm going to be
activity with
completely
long
honest with that
variable
one.
lags.
All right. Sitting
Of
on my
course,
hands
these
and literally,
days,
I opened.
financial
I
conditions
think it
begin
was-
to tighten well in advance
It
of
was either
actual
the beginning
rate
of
hikes.
last
So
week or the
if
week
you
before
look
that.
back when we
But
were
I
lifting
funded an
off,
account with
we
500
started
just
talking
so I
about
could
lifting off.
scalp
By the time
and
we had
start
lifted
testing my own
off,
strats.
the
And
2-year, which is a pretty
yeah,
good
I've grown
estimate
to
of
like
where
honestly
policy is
just
going, had
getting
gone
it out,
from
guys.
20
It's
basis
pretty-
points to 200 basis points.
Pretty
So in
fun.
that sense, tightening happens
I'm not
much
going to say
sooner
you're going
than
to
it
see the
used to
biggest
in a
moves,
world
but
where-
you
where-
can literally
where
just go
news
level
was
to
in
level off the
newspapers and
pre-market
not,
levels in the
not
morning.
on the
Believe
wire.
them now, but
So that's
I've
different,
been
but it's
doing
still
it
the
for morning.
case that what you see is interest-sensitive spending is affected very, very quickly. So
the
housing,
5-minute
durable
chart,
goods and things
guys,
like that.
I'm just going to say, I
But
think the most
broader
amount of people
demand
use the
and
5-minute out of all the
spending
smaller
and-
time
and
frames.
asset values
That
and
is
things
where I
like that,
see
they just take
levels
longer.
getting respected the
And
most. In the
you can pretty
5-minute.
much find research to support whatever answer you would like on that. So there's not any certainty or agreement in the profession on how long it takes. So, then that makes it challenging, of course. So we're looking at the
Get rid of
calendar,
this.
we're looking at what's happening in the economy. We're having to make these judgments. Again, it's one of the main reasons why it makes sense to go at a slightly more moderate pace now as we seek that ultimate. I can't point to that.
I feel like you're not going to see a massive
Can't point to a
sell-off
specific
today, just from
data
like the
point.
sounds
I
of
think
what he's
we'll see
saying.
it
But
when we see inflation really flattening out.
I'm not going to say it sounds
reliably
like,
and then
great.
starting
Like
to
the market
soften.
could
I
start
think we'll know
pricing in
that
future rate hikes,
that it's
but at the end of the
working.
day, guys,
And
we have another
ideally,
like
by-
month
by-
or so
by
until
taking
the
a
next
little more time,
meeting.
we
So
won't go well past the
I'm going to point out my video
go.
where SPY and QQ are sitting
curious
at.
if
They
you
don't
could
really,
give
they're
us an
not
update
at
on what you're seeing
resistance
on
right now.
credit
So
tightening since the
like, look,
bank
we're
incidents
like,
for March,
this
and
is
how
the
you're teasing that
spot
out
over here on
apart
SPY I was
from
calling
these
out.
lag effects.
One of my
it's
previous
too early
videos,
still
maybe it was
to-
a weekly
to
update.
try
Right
to
here, you
assess
got
the
the
full
structure,
extent
but in
of what
reality,
that
it
might
got
mean.
filled, and the next stop
that's
is
something
over
we're
there.
going to be watching, of course.
Hey, you gotta
and-
be open
and,
to it.
If we were to see what we would view as significant tightening beyond what would normally be expected because of this channel, then we
Yeah, I
would
will
factor
point
that
this
into
out, though,
account
in the video as well.
in making rate decisions. So that's
Or not
That's how
on
we think about
QQ
it.
over here on SPY.
Thanks. Chris Rugaber at Associated Press. You mentioned that many of the trends are in place that you want to see. Core services ex housing has come in pretty low in the past couple of months. And as you noted, a significant portion of core inflation is now housing prices. And then we've had some quirks in used car prices. So given that these trends are in place, I guess I'm sort of asking the flip
All right, we got to
side
start
of Nick's
getting off.
question.
We'll call it at 3 o'clock.
Why signal
Go
additional
record the
rate
video.
hikes? Aren't things headed in the direction you need? Why not simply give it even more time? Or I mean, it's surprising to see so much hawkishness in the dots, given what we're seeing recently.
Yeah. So, we've we're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and traditionally, not typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level.
Oh, that's
over
not something you
4.5%,
wanted to
far
hear.
above our
Like,
target,
again,
and not
the market
really,
doesn't give a crap,
moving
all
down.
right?
We want to see it moving down.
You've had, like,
decisively,
bearish
that's all.
things in the
Of course, we are
background, and
going
I've
to
been
get inflation
telling
down
them
to 2%
on the
over
channel how it
time.
is, and like, hey,
We
people just
don't
look at
wanna
me as a
do-
perm
we wanna
fan.
do
No,
that
I'm
with
a
the
complete
minimum
realist,
damage we
right,
can to
guys?
the economy, of course.
I'm completely
But
open
we
to
have
this
to
thing
get
going
inflation
up.
down to 2%, and we will. And we
Just
just
saying,
don't
you have
see
a lot
that
of factors
yet.
across the
So,
board, and now he's saying
once you
things
see
like
today's
this.
policy decision,
I don't think it's in the
both to
Fed's best
write
interest
down
to make this thing
further
rocket.
rate
That's
hikes
what
by the end of this
I'm gonna
year,
say right
but
now.
also to take to
I think he's being
moderate
cautious.
somewhat.
But he's
the
also not
pace with
saying
which
anything
we're
that's going to
moving.
tank the market right away. Like, this is something that maybe overnight we get a reaction to.
Quick follow-up.
Something like that. Maybe you get a gap down. Let's look at the daily time frame, all right?
And there was some
You get a
research
gap
from
down,
the
it's
San
not really gonna
Francisco
create
Fed
anything
suggesting
unless you,
wages aren't necessarily
close
a
out
key
the day
driver.
down there. We'll see.
But you talked about the labor market today and the need
So
for
far, you're still
softening.
just
Can
stalling
you
out up here. But
give us a
again, you
little
don't have
more
resistance
specifically
right
of
where
how
we
you
are.
see the
Then
tight labor market driving
It's over
inflation
here
at
on
this point?
SPY.
Thank you.
Right. So I'm not going to comment on any particular paper, but I would say that I think the overall picture is that at the beginning, in early 2021, inflation was really coming from very strong demand largely for goods. People were still at home. They had money in the bank and they wanted to spend, and they spent a lot on goods. And of course, at the same time, and because of that high demand to some extent, supply chains got all snarled up. So prices went way up, inflation went way up. That was the origin, and it wasn't really particularly about the labor market or wages. But as you moved through 21 into 22 and now in 23, I think many analysts believe that it will be important, an important part of getting inflation down, especially in the non-housing services sector, getting wage inflation back to a level that is sustainable, that is consistent with 2% inflation. We actually have seen wages broadly move down, but just at a quite gradual pace. So, and that's a little bit of the finding of the Bernanke paper with Blanchard of a few weeks
Crap,
ago.
I
which is
just
very
realized my mic was
consistent
on
with,
mute. Hey guys,
with what I
PC, favorite
would think.
indicator from Mr. Powell over here for whatever it's called, for inflation. So
Michael McKee from
I don't think he
Bloomberg
cares too
Radio
much about
and,
CPI or
television.
PPI.
You said in the
It's all
past that
PCE
you
for
don't
him.
like to surprise
Um,
markets. It's kind of
that's
been the Fed's
why,
view. Markets should have an idea of what
Other
you're
than
going to
that,
do before
guys,
you
there
go
really
in.
isn't anything
you also
that's
said a
too
number of
terrible
times
in
that
this.
it would take
You might have
a
to see
while
this
to bring
them,
inflation down. You reiterated
like
that
maybe it's
again
an
today, and
overnight
that
move that
we
takes
get to a
place.
point where inflation could be
But
sticky.
there's nothing really
So I'm
that I'm
wondering,
hearing that's
as we
going
go
to
into
tank
the
the
next
market right away.
meetings, how Wall Street or
Something to
others
note.
should look at your reaction function. What will you be reacting to time or data.
But
In
hey,
other
guys,
words, if
you got
nothing
back
much
above the zone.
changes,
That is
if we're
what you
looking
wanted
at
to
the
see if you're
same
going
sort of
long
labor
here.
market, the same sort of
Putting that out
inflation
there.
levels in July
Anybody
or in
who's
September
potentially scalping this
or
thing, I don't
November.
know.
Will you move because you've said you feel you need to? Is it time that's going to require additional movement, or would it be a reversal in inflation?
So I don't want to deal with hypotheticals about different ways data might move out. So we of course we don't go out of our way to surprise markets or the public. At the same time, our main focus has to be on getting the policy right, and that's what we're doing here, and that's what we'll do for the upcoming meetings. I will say the July meeting will be live.
Making big bucks off
and,
autos in the Discord. Holy Jesus!
We'll just have to see. I think you'll see the data. You'll hear Fed people talking about it,
I'd love
and
to see
markets
that
will have
today.
to make a
That's
judgment.
okay.
Well, do you
Yeah, I
think
took
inflation
Tesla earlier.
is
I didn't get to take the whole
likely to
position.
continue coming down based on the
not
lags
tight,
and
but the
based
plan
on
is the
your
plan for the
threat of
reason.
additional
It's
movement?
okay.
Or are we going to be
I
in a
got to
period
cut my
where we're
one
not
put
going to know what's
right at the
happening?
bottom because that was the first take profit
I
level
think
right here.
If you look at
Probably didn't catch the exact bottom, but
if you just look at,
up
I'll
to
just point you to
385,
the
not too shabby.
forecast. So inflation is running, core PCE inflation is running at
But
about
again, it's
4.5%,
against the
a little
trend.
higher
Like
than
I'm going
4.5%,
to straight up with you guys on this one.
FOMC
You see
participant thinks
Tesla.
it'll go down
Tesla's
to
been skyrocketing
2.9
for
on a
quite some
12-month
time, right?
basis. This is
You
by
can
the
look
end of
back.
this year. So that's expecting
this
pretty
other-
substantial progress.
Over here.
That's
All
a
right, you've
pretty
had, I think
significant
it's
decline for
13
half a year.
straight green days. Let's
So
just count these
that's
together.
That's the
All right,
forecast.
so you had a red day, green.
We do try to be
3,
transparent in our reaction
4,
function. We're
5,
committed
6,
to getting inflation
7,
down,
8,
and
9,
that's the number one thing.
10,
So
11,
that's how I think about
12, 13. All right, so if this thing closes green, the trend is still
Leo with
going to
Politico.
continue, but like
Could you talk about
at the end of the day, I'm
balance
pretty
sheet
sure
and how
this
you're
thing is
thinking
not
about
going to
it?
sustain
What
this.
what
know,
are you looking for
mass
to
amounts of
judge
green
whether
days back to
we're
back to
approaching
back.
reserve scarcity
You're at
and
least
is
going to get a
Treasury
decent
issuance
pullback.
going to
I mean, you
affect
just
that?
came to fill that
Also,
gap,
are you
so
considering
I'm
lowering the
ultimately looking
RRP
for the
rate in
second
order
gap,
to
though.
take some pressure off banks?
But
So let me say
yeah,
first of all, on
the
the
same as
Treasury
SPY
part of it,
QQ
I
guys.
can
You're
talk
not
about
at
that
like,
and
I
then
mean,
go back to the
I
balance
guess you
sheet.
kind of are slamming into resistance. You got
on
this
that,
gap and you got the structure
of course,
here.
we've
but
been very focused on that for a couple of months, as everyone
yeah, I've been
has.
seeing
Treasury has
Tesla
laid out its
300 on
borrowing
Twitter,
plans
so,
publicly.
you know, from
I
a
think
few
we all
different people.
saw. I saw the Secretary's comments yesterday to the effect that
I'm not going to say
Treasury
it's
has
not going to happen,
consulted
dude. Tesla's
widely
done
with
some
market
crazy things in the
participants
past.
about how to avoid market disruption, and that
Why
they're
not
going
this
to
style?
watch carefully for that. So
Look at that thing.
That's
See
from
that
the Treasury,
RSI?
which actually sets the
Absolutely insane.
the borrowings.
But it has gone
Fed,
higher, so
we'll be monitoring
there's also
market
something. No, but
conditions
then again, it went
carefully as the
higher.
Treasury
The
refills
end of the bull
TGA.
market, right
The adjustment
before,
process is very
market
likely
started
to
pricing
involve
all
both
this,
a reduction
pretty much
in
pricing the bear market.
RRP facility and also in reserves. It's really hard to say at the beginning of this. Which
At this
will be,
point, that's why I kind of
which will
want
be
to be
greater.
nimble on that. All right, at this point,
we are starting
look at
at a
this. So you
very
did
high
get
level
this
of
pullback.
reserves,
That could be today, and then
still
guess what?
elevated
From that
over
pullback, you went up
RRP
another
to
20%.
take up for that
You want
matter.
Tesla
So we
going
don't think
against the
reserves are likely
20%? Probably
to
not.
become
All right, so if you are
scarce
going
in
to try,
the
I
near
would
term or even over the
definitely have
course of the
a
year.
stop in place. All right,
So
have that
that's-
level. You're going to
that's the
profit or
the treasury
percent, whatever
part
you're
of the
doing.
answer.
Have
we
it.
will of course continue to monitor.
It is a monster.
Conditions in money
Yeah, it
markets,
could sell
and
out
we're
pretty
prepared to
quick,
make
but it's a
adjustments
monster.
to make sure that monetary policy transmission works. Was there another part of your question?
Yeah. What are
I
you
wanna just
considering
keep
lowering
listening,
the
dude.
RRP
Dang.
rate to help take
I'm gonna
some
have to
pressure
come
off
back
banks?
and
we
listen
have
to
a
this.
number of.
Or actually,
I
no,
would
I'll probably
say,
just look on.
the
I
RRP
think
doesn't
it's
look like
CNBC.
it's
Always
pulling
has
money
the
out
or
of
it's
the
CNN.
banking system. It's actually been
They
shrinking.
always got
here
the
lately.
you
So
know,
I
the
don't
script
think,
for this. Not script,
that's not
but, you know,
something
someone took the
something
notes on
we've
it.
thought about a lot.
We'll probably
over
just right
time.
over
It
that
doesn't
instead of
really
listen to
look
this
like
again.
That's something that we would do. I think it's a tool that we have. If we want to use it, we can. There are other tools we can use to address money market issues, but I wouldn't say that that's something that's likely that we would do in the near term.
They have other tools, guys. They have more tools in
Janelle
the
Marte
tool
with
chest.
Bloomberg.
All right, guys. I'm
Have you
gonna
seen
cut
sufficient
this
cooling in
right
the
now.
housing market
I
to
just
bring
want to keep
inflation
listening
down?
to them.
For
Like,
example,
what
how
if
does
something
the
happened? But
recent
also, you know what?
rebound
That's
affect
FOMO,
your
guys. Right? I'm
forecast?
fear missing out
And
on
how
what
does
Powell's
it
saying.
factor
All right.
into monetary
All right.
policy?
That being said.